This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Nigol Koulajian. Not filtered, raw, honest. That's my passion. A quick reminder before I get into this podcast. If you like this podcast, go on to iTunes and say something. What do I mean? Go write a review on iTunes. Come on, these reviews help the process. It gets more eyeballs. It gets more rank. It allows me to keep asking really smart people to come on and talk with me. So your reviews, good or bad, I mean, you can go say all kinds of praiseworthy things on iTunes. You can rip me a new one. But go on to iTunes and write a review. And the short URL to get you there is www.covel.com/iTunes. That's Covel, COVEL.com/iTunes. Will take you right to my iTunes page. You can write a review for your time and toil. I will send you a free DVD of Trend Following Extras. Just drop me your address. My email address is real simple. My first name at my last name, Michael@Covel.com. Write a review, drop me an email. I will send you a DVD and hopefully further along your education in the trading space. Now let me jump into the more important stuff. I see that Ray Dalio of Bridgewater, the most successful, the most accomplished hedge fund manager in the world, who trades, by his admission, a 100% automated trading approach. Using fundamentals, though, so he does not clarify himself as a trend-following trader, but says he is 100% mechanical in the execution of his system. Recently, Ray Dalio has come out and has made a parallel to 1937, saying that the United States Federal Reserve faces a similar set of circumstances as they faced all those years ago. Stock market heights, bond heights, everything is just extremely pulled like a rubber band. And interest rates at zero, below zero in Europe. And Dalio, again, with a 100% automated portfolio, is saying that he's concerned is not taking concentrated bets because if rates rise, if the United States Federal Reserve pushes rates up, he's not sure what will happen. Of course, no one's sure what's going to happen. But Dalio takes it a step further and he's saying, since we don't know what's going to happen, what will you do if things go wrong, Mr. Federal Reserve? Good question. I can only assume that they will, quote, print more money. What other option do they have? So, if I follow through on Dalio's logic, we are facing the situation of either keep the bubble going, number one. Number two, pop the bubble. Or as I have said on social media, number three, my favorite choice, unicorns for everybody. My guest today is Nigol Koulajian. We are talking all things that are trend following in the CTA space, the pros and cons, the ups and downs, the perspectives, the criticisms, all types of territory. In fact, I would really consider this part two of my conversation with him from the fall of 2014. I hope you enjoyed this conversation with Nigol Koulajian. This non-correlation benefit that's long been talked about is just not showing up.
Investors don't seem to be requesting it because the returns in equities have been so high. The rolling Sharpe Ratio of the S&P is the highest it's been probably since we didn't go back to 1929, at least in 50 years. The rolling Sharpe Ratio of the S&P is now over 2. The closest it's been to this was in 1999 before the 50% or even more drop in NASDAQ. The second highest was in 2007 before the drop that happened there, 50% in the S&P. So today we're higher than those levels. So the fact that equities have been so friendly, even CTA investors are saying we don't mind if our CTAs give us equity returns to embellish themselves, although they know that this is only a superficial embellishment and no value in the portfolio.
I mean, if I was an individual investor, not that the individual investor that makes up the pension fund money, they don't even know who their pension fund manager is that's making the CTA allocation. But it's patently absurd to be paying fees to receive a product that should be a true diversifier and then add it in and you're paying fees and you're basically saying, hey, we don't even care if this looks like what it's supposed to look like anymore.
Behaviorally, people are very willing to just chase returns because it feels good. So what you know and I know and pretty much everybody knows intellectually what is the right thing to do, it's very hard to follow. It just feels way too good to be right in the middle of the crowd when you feel unsafe. And nobody's willing to adventure on their own or to having independent thinking is just very, very difficult emotionally these days. So even very smart people, and definitely that the investment committees of these pensions, etc., are very smart people, but they have a very hard time taking independent steps in any way.
But there's a reason for that. I mean, they get paid.
Getting paid, a lot of, everybody gets paid, even, the criminals get paid too. But, you have to think of what's a good long-term value for your investors, rather than doing what is easy to do, which is justifiable based on the current information out there, what is justifiable based on what you read in a newspaper. Those things are very easy to do, but they're very harmful in the long term.
But isn't that typical in American society these days? If we just pick on American society for a moment, whether it's politics or central bank actions, and now pension fund managers and their actions, it's all about what feels good at the moment. There is... And it's quite amazing because for so long, trend following has really held itself out as that true diversifier. And now you're kind of, from the front lines, you're basically saying, I don't even see it anymore, Mike. Is that a fair assessment?
Yeah, you know how groupthink works. And the further away you are from reality, the more you want to hide in the comfort of the group, because that fear inside you most people don't want to feel. And everybody's kind of like in a deception mode and you're happy to go along. So I would say the further away from reality is, or like the lower the ground is underneath you, the more you try to hold on to whatever you can grab onto, and the only thing you can grab onto is groupthink.
We're talking some of the smartest people in the world that are making these decisions to basically say, we'll take the watered down CTA investment just because we've got a checkbox to fill and we no longer care if it really delivers what it's supposed to deliver to begin with.
Intelligence is something, we speak about at a conscious level, but investment decisions are not made at a conscious level. They're made emotionally and they're justified intellectually. So, yes, people with very high IQ can be, can do things which are very, very harmful to themselves, and it's not so easy to stop that from happening. So yes, intelligence is good, and it's nice to listen to them, but at the end, having the integrity if you have a certain integrity and discipline, you can actually avoid these mistakes. But I would say a normal human being without a lot of preparation is not equipped to make these type of decisions that independently. With so much emotional negative feedback coming, they prefer to make what gives them positive emotional feedback. And those are very, very costly decisions.
Correct me if I'm wrong on attributing this to you, but the notion that alpha in the CTA world is not a result of skill, but exposure to tail risk and central bank influenced markets.
Yes, in the last 10 years, and we wrote many pieces to explain this, effectively where the money is going within the CTA space has all been due to benchmarks, which are, let's call it more traditional CTA type benchmarks, are the new managers that are coming in are the ones who have exposed themselves to tail risks through buying the dips in fixed income, buying the dips in equities, relying on the correlation of fixed income and equities as a way to provide returns during equity corrections. The alpha on a dollar basis in the industry today is all about that. Actually, I would say that the alpha in the whole hedge fund industry is not, and I would say a minute amount of it is due to scale. 99% plus of it is due to exposure to tail risk. So what we have found is that tail risk exposure and Sharpe ratio are highly correlated, and Sharpe ratio and large Sharpe ratio and large drawdowns are highly correlated as well. Effectively, we're saying that investors are measuring risk linearly, and therefore they're missing on the tail risk that comes when the big drawdowns come, and they're thinking that this high Sharpe ratio is due to scale. We're saying we can easily replicate that through, instead of linear risk. So don't look at the market volatility as a predictor of drawdown. Look at the skew as a predictor of drawdown. When you do that, whether you're looking at the stock market, whether you're looking at hedge fund manager, whether you're looking at CTAs, you can really tell who is really contributing true alpha and who is really just giving you numerical alpha, which is purely tail risk. Very, very important. I would say today, due to the stubbornness of market regimes based on what central banks are doing, there's a lot of patterns which have repeated very consistently, and if investors don't use skew as a measure of risk today, I would say they're relying on very unstable patterns. It's a question of time before they reverse substantially, and once again, you will see 30 to 70% drawdowns in hedge funds and in the equity indices if investors are not careful, and right now they're not.
Go ahead for me and talk about your feelings the first moment where you're talking about central bank actions here.
Yes.
And one of the biggest that's happened within the last 30 days was with the Swiss Franc.
Yes.
Talk about your feelings, how you felt about that. Did you immediately have the gut feel of like, this might be the dam breaking. This might be the new period of volatility to start to appear upon us?
So the Swiss franc move, dollar Swiss, if you look at as a multiple of 1 year daily volatility, dollar Swiss was over 50 standard deviations move. Euro Swiss was 180 standard deviation move. Okay, so the vol was so low, but everybody knew that these two markets were supported by the Swiss National Bank. So the fact that they moved like they moved is no surprise, and anybody who is in the financial market knows that today's markets are heavily stretched away from natural equilibrium. So when the move happened for us, we had positions which, with very close stops. So we got stopped out like within 5-10 minutes. Also, we're not trading, 50 billion with, a 1 year momentum strategy. We have positions that we have very tight stops. Within 5-10 minutes, we're completely stopped out. The liquidity in the market is plenty. So when the move happened, it was not actually a gap. It happened over 15 minutes. There was plenty of opportunity to get out. But we were laughing because we know that most trend followers today don't have stops in the market anymore. Due to their size, and due to the fact that these very long-term strategies have been the most profitable due to central bank support, we know that most CTAs didn't trade until market on close or market on open the next day or even later. We're laughing because, Switzerland is a tiny little country, but it's only something to remind you that the whole world is so distorted and that so easily things can go extremely out of whack. And we're not talking 1 or 2 standard deviations. In this case, we were saying there was a 180 standard deviation move based on daily volatility.
That's just insane, isn't it?
It's okay. So you're in a movie and you're saying yes, and the movie is reality for a while. When you really get used to the movie as being the current reality, then when you go back into reality, that seems absurd. This is what happened. Everybody is living, I feel like, in an extremely some sort of self-deceptive mode, and once reality is kind of peeking in, even a tiny bit, it seems so shocking. Nothing shocking happened, except it's shocking because we're so used to something which is unreal. What happened is a reality. That's a natural price, a more natural price, I would say, for the Swiss franc. So we're all living in that, kind of fake world now.
But you say, everyone in the markets knew that the Swiss franc was supported by central banks, so it's not really a surprise. Fair statement. So what are the other sleeping giants, so to speak, that everyone knows are being supported by central banks, and it won't surprise when something happens?
I mean, the most obvious one is, of course, interest rates, where all the big, whether it's Japan, whether it's Europe, whether it's the US, call it 95% plus of the world's liquidity, those interest rates are completely artificial. And today, when you buy 10-year bonds, 30-year bonds, let's say at least 10-year bonds, from a purchasing power perspective, you're guaranteed to lose money. Guaranteed to lose money, and people are still putting money there. I'm saying you can go buy anything you want. You can buy, cars, clothes, whatever. I mean, this is a guaranteed loss. Somebody's saying, I'm gonna take your money away. I guarantee it, and people are still investing there. So, I would say that's the most obvious one. From there, which is closely arbitraged to yields, to treasury yields, you have the stock market. So both, I would say, fixed income and the stock market today are places where you could expect similar moves in the future. Switzerland is, I would say, pretty independent still from kind of the world, whatever you want to call it. This one government type of system that's going on. Switzerland is still independent, but and it chose to just step out without much warning. So other central banks, I would say, would be more cooperative and more gentle in the way they step out if they would. But these things, it's not a question of if they happen. There's no doubt. It's only a question of time when it happens. There's no doubt. It's like reality always wins. It's just a question of when.
Well, let's talk about that win for a second. So trend following CTAs often have done very well in equity market corrections. And I've seen you make some statements, and I'm generalizing, I'm paraphrasing a little bit, but you don't see the trend following trading strategy being as good of a hedge in equity market corrections as years past. Is that a fair statement?
Very fair. I would say that the ability to provide returns during equity corrections comes from short-term trading, which is more positively convex, or from trading shorts. Today, due to the longer and longer-term time frames that large CTAs are using, the returns that are coming during equity corrections are not coming from positive convexity. They're coming from the fact that they're long fixed income, and the correlation of fixed income to equity has been negative. Once the correlation of fixed income to equities goes to positive, and if you look at it over the last 100 years, most of the time the relationship between equities and fixed income is a positive one. When that comes, that you will see that these large CTAs, which have provided the best returns in the last 10 years, based on risk on trading, will not be able to provide returns during equity corrections. It will take them 2 weeks, 3 weeks, 1 month, 2 months, 3 months to reverse and go short if there's a type of fast reversal that happens.
But you're talking trading equities only?
No, I'm talking all markets. So effectively, when equities reverse, you have today the negative beta to equities is coming from fixed income. I mean, commodities have been relatively flat. I would say in a general downtrend. So if equities go down, and you need other markets to provide your returns, catching the reversal in equities, I would say, will take a month or 3 weeks to a month before in today's world, based on the time frame that typical CTAs trade, I would say it would take between 3 weeks and a month to actually short the stock market. Same thing in the case of fixed income. The stops are very far away. A typical benchmark of what CTAs are doing today is the price 1 year ago. So the S&P is 15% down from here before they actually. That's like a good benchmark of the large CTAs, or something like a 200-day moving average, which is also very far. Those are the points where today, if you replicate the index, you would say this is where CTAs are going to reverse.
Define for me equity correction, though, because we really haven't had, I mean, there's been some spells in 2010, 2011, but we really haven't had a big spell since 08 or 09. We've just had one massive S&P move. We haven't had that typical kind of washout, really terribly scary moment in the S&P for several years now.
Correct. So, as you know, I mean, fundamentals are great, but, any market can drop 50% within, a very short period of time without any fundamentals that were visible at the beginning of the move. So crude oil just dropped 60%. You would say, was it a visible move? Most people who were very smart and do tons of work did not see it coming. Fundamentals, it's very nice, it's entertaining, but at the end, there's something in the price which is not known fundamentally. You cannot, and in today's world, the technical picture in stocks is very, very dangerous because the psychology behind the market is so skewed towards, there's a lack of fear, there's such a deep confidence that the trend is going to continue, and money is allocated in that type of, towards that type of picture. So, although people know that a correction can come, steadily over time, I would say that their willpower has been depleted by the steady temptation to go long the stock market. So whoever said, I don't believe that this market can go up, everybody has given up on it and everybody is long the stock market. So let's say majority, because it's been so easy and such a steady rise. So even with intelligence, even with willpower, I would say that most people don't have the ability to resist such a tempting move. And therefore, even the large and very smart investment committees, et cetera, are very unprepared for an eventual correction in the stock market.
Another move down. This isn't hard to imagine, but another move down in the S&P, let's say 45, 50%. That's not hard to imagine given the last 15 or 20 years. But another move down of 50% in the S&P, that sure would be a wake-up call, because I think that would be it's just psychologically, if people then are sitting there looking there and saying, my gosh, I've literally not really had profits since the mid to late 90s. That would be a real psychological downer.
As much as people wake up, they also have the ability to go to sleep. Do not underestimate people's ability to deceive themselves.
Yeah.
So, what the markets can do today, purely based on some simple stats, market cap to GDP, rolling Sharpe Ratio, velocity of money. Velocity of money is the lowest it's been in 60 years, 65 years. So money is being pumped in the economy, and it's not going to pump the economy. It's going to create bubbles. It's going to creating bubbles. The rolling Sharpe Ratio, highest in also 50, 60 years. Market cap to GDP, Warren Buffett's favorite stock market indicator. The only time it was higher was in 1999, when the Nasdaq crashed basically, and the stock market went down 35%. So we're at similar levels. We cannot time when it happens, but we're saying we're in a very dangerous place.
Let me jump around to some other subjects as I move you away from doom and gloom for a second. I know you're not. Look, you're a quant guy, so I know what you're looking at. You're looking at the numbers, and you're just being very objective, and you're saying, "Hey, this doesn't add up," or it does add up, and it adds up to something that we've seen before, and usually it will probably play out the same again. You just can't predict when.
Correct.
Yeah.
You just have to be ready.
Yeah. Talk about the idea, though, that there's so many people out there. I get a lot of emails from people. And a lot of people get fixated on the notion of much higher level math. And of course, a great statistical, probabilistic understanding, great math background can be fantastic for the quant trader, the systems trader, the trend trader, etc. But it's not about the super complicated math. It's actually about less is more. Why don't you talk about that?
So, effectively, if you're born and you're told you're great at math, and you go and you get a math PhD, you graduate and you join a financial firm, and then somebody tells you you're going to be using high school math to design trading models, you're not going to be feeling very good about yourself. There's a very, intellectually, before we go into the market, emotionally, people are very much rewarded socially for being mathematically smart. You have to know that there's a tendency to overuse that tool that we have, just in the way, based on how society is, biased. Now, what's going on in the markets? Computers, the ability to optimize, you can get for a couple of $100, and you can get, optimizing software, et cetera, which is very, very effective mathematically to tell you what patterns have worked in the past. In a market which is normal, where you don't have one player which is heavily influencing the market regime in one direction without any counterweight, what you have in this type of market is the ability to optimize at levels unseen ever before, because the market is so monothematic. So you bring this type of market and you put an optimizer on top. You got equity curves like this. You can end up with a Sharpe Ratio of 4, 5, 6, 10. No exaggeration. I mean, literally.
Yeah.
So this is what's available today when you mix advanced math with markets. Now, as you know, markets are not about, these optimizations are highly unstable. The market is there to counterweight what everybody believes. If everybody believes that the pattern of the last 10 years is going to repeat, then the market is going to do exactly the opposite. So the danger with math is that it's leading all these places who normally you know why you're doing something, but when you use math, you have no idea. So people assume because of a certain type of correlation that there's a causation between a cause and effect. In reality, that correlation is not really a cause-effect relationship. It just happens to be there because of one factor, which is typically central banks. Very, very, very dangerous mix, very explosive. I mean, this is no surprise. I mean, the smartest guys are the ones who have a more rigid view of the universe, and that rigidity is the one that breaks, such as LTCM, such as some of these other firms that blew up first in 98 and then in 2007. So the highest Sharpe Ratio, the highest advanced math, knowledge are the ones that had 70% drawdown because they were aiming for Sharpe Ratios of 4 and 5.
Well, so, the dead bodies that surely exist from the Swiss Franc move, not many of them have raised their hand and said, "It's me," yet, have they?
Actually, there's just maybe a couple of funds that shut down, but Swiss Franc is a very small position in people's portfolio, so it was more like an indicator. I would say the impact was small because of its position, but that was only by chance that it was so. When the same thing happens in a more visible market in people's portfolios, the combination of math and optimization, which is available today, will be a shock like we've never seen. I would say the Swiss franc is only an indicator of what can happen. I would say nothing has really happened yet. It's just too small in the portfolio to matter that much.
Let's talk about it. I want to get your perspective on drawdown. So many times over the years, I've seen, whenever you see an article about systematic quant strategies, trend following, invariably the subject is drawdown. Drawdown, 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 drawdown. Warren Buffett's had some fairly steep drawdowns. The S&P as a buy and hold investment has had some fairly steep drawdowns. But a trading strategy, a quant strategy that actually knows that it's going to have drawdowns in advance. You can literally tell your clients, or the individual investor can know this is going to happen. There's not going to be a straight up equity curve move. How do you get people to understand that? How do you get people to understand that drawdown is not necessarily an indication that things have gone wrong, or not necessarily an indication that things are broken?
I mean, a lot of assumptions go into what makes up our psychology, and that's the most difficult thing for people. Basically, when something is going down, people assume it's going to go down to forever. It's going to go down to zero. And when it's going up, they assume it's going to go up forever. It's never that bad on the way down. It's never that bad on the way up. Can you intellectually explain that to people? I would say that's the place where the intellect is the least useful, because the emotions are so strong when you're losing money. Okay? So it's a very, very difficult balance. It's the most difficult aspect of investing. So even, let's say the value strategy, or, Warren Buffett, or the long S&P, if you can hold on forever, let's say 100 years, 200 years, whatever it is, yes, it's supposed to always go up, assuming the economy continues to grow. But the 1% chance that you're wrong, which means you lose 90% plus of your investment. So drawdown is something that tells people at the edges, and it's such a high risk place. It's basically it's exactly what is beyond the intellect. It's a place where the intellect is the weakest, and the preparation for that is really ideally, first, a very deep understanding of what the models do, and ideally living through, if you're looking at the simulations for a systematic model, living through the model over as long as possible, day by day, looking at positions, understanding where it loses money. That will give you some comfort. Then there's nothing like self-analysis. I mean, you have to be really honest with yourself whether the edge that you've had in the market is something which is sustainable or it's something which relies on something very unstable. If you're, an option, if you're selling puts on the S&P and it's worked extremely well in the last 5 years and now you start experiencing a drawdown, there's a place where you need to look at yourself in the mirror and say, this is where I deceived myself. It's the same thing for trend followers. Trend followers can optimize their models in a way which is not sometimes ideal. So when they're in a drawdown, they need to look at themselves and see what they can learn. Now, what happened in the last 5 years, because CTAs have been going through a 4 or 5 year difficult period, they've all changed their models to do certain things which would have improved their performance in the last 4 or 5 years. There's a new type of filtering, and I would say that even that is a very dangerous thing, because now that if real trends start coming, then I would say CTAs might not be able to catch them as well because they've deviated, or the factors that they expose themselves to have drifted to adapt for the last 5 years. So drawdown, you have to know, it's a very, very, this is the key to, I would say, investment management, is to understand how to react to a drawdown. React or not react. Sometimes you don't want to react, but sometimes you have to react. And the key is to have some perspective, to have a real understanding of the investment process, what are the drivers, and, really make decisions not based on the fact that you lost money, but on the fact of what you think the future is going to bring. So it's a very difficult aspect of investing where not only intellectual intelligence, but emotional intelligence is key.
So why do you think there's a media bias against trend following drawdown, but almost an ignoring of the S&P historical drawdowns or the Warren Buffett historical drawdowns? Why are trend following drawdowns picked on?
Well, because trend following, first, the media is supported by the financial system. The financial system is paid by selling equities and investment banking, not by CTAs. So if CTAs were, as large as, the equity world, you'd have more representation of CTA supporting ideas in the media, which is not the case. So the media picks on CTAs because CTAs are always there to brag that they made money while everybody else was losing. So now the media is getting paid by the equity world. It's natural that they protect whoever is advertising with them. So there's no intellectual, if you look at it empirically, there's no question, let's not say no question, at least that the trend follower is at least as good as value investing on a return to drawdown basis. At least. Now, how come that's not something that you hear every day? That something which is not intellectually as palpable has worked better than all this intelligence and all the hard work that people put behind value strategies, all the research. There's something which is extremely simple, which has worked, let's say, at least as well. Empirically, it's actually better.
And from that standpoint, you see moving averages, channel breakouts explaining most of trend following type returns.
Absolutely. Yeah. Yes. Let's say that's enough to replicate the index in the space. In the same way that the S&P is a very good way to replicate what Warren Buffett does. So if you look at them on a beta-adjusted basis, you see that Warren Buffett is not that far from what the S&P has done on a risk-adjusted basis.
It took me a little while to figure out, and I'm not saying this in any kind of arrogant way or bragging way, but it took me a little while to figure out why so many, of course, relationships and talking to people over the years, but so many trend following traders enjoy talking with me. I think it's because I will go out there and I don't mind getting punched around and kicked and this and that. It's kind of like being at the tip of the spear to some degree. Whereas I don't think it's kind of harder when you're a manager in a style of trading that gets beaten down by the press. You really don't want to stand up and fight as much. That can cause more problems too. But I have noticed some changes in the last bunch of years. And for example, you're very outspoken. And I think people are starting to to push the issue to get people to think more about this intellectually, what these different styles of investing are. For example, and I generalize here as I say long the S&P, Warren Buffett, and trend following, but there's no reason that trend following should be a pejorative.
Of course,
you don't even know where to go now. You're just like, Mike, I don't know what you're talking about.
Of course, but you have to look how the system operates. Again, the system operates by selling and making commissions of equities, of investment banking advice, et cetera, et cetera. So the fact that trend following is looked at negatively, and despite, I would say, risk-adjusted returns, which are as good, if not superior, to the other style, they're constantly underweighted in typical portfolios. That's something that investors, have paid a very heavy price by not having more trend following, and they will continue to pay. But again, what feels good, there's ways to create false realities and to have people live as per these false realities. We know that. So people smoke and it's not good for them, and they buy stocks when it's not as good for them as they think it is, even when it's not. So there's systems to do this, and it's not a mystery. You can research them, and you can say people can live many years, and they can even do things which are to the point of harming their own health. Forget about harming their portfolio. So why would they not buy stocks, even if it's harmful? Or basically, deception is very, very easy. It's very easy to manipulate crowds. In a system where from all the way from kindergarten up, they're exposed to a certain type of thinking. By the time, they have money to manage, I would say they're very easily swayed one way or another.
Nigol, let me ask you one last question about trend following 2014 performance. Across the board, looking at a wide selection of managers ranging from, 15, 20, 50 million, 100 million, several billion, 5 billion, up to 26 or so billion dollar fund, $26 billion fund. Across the board, performance was really, really exceptional for 2014
It was that way because first, remember, equities were on their way up, fixed income were on their way up. So most portfolios, whether you're doing long only, you're doing GTA, you're doing all weather portfolio, it didn't matter if you traded.
I see your point.
So it doesn't matter your CTA. Your models didn't even trade the whole year. Fixed income was almost in a straight line up, and so were equities. So this is what you start with. Now, the fact that it was a good CTA or a bad CTA, basically performance in 2014 was not like a skill. It wasn't dependent on skill. The typical portfolio made a lot of money, right? And the correlation between equities and fixed income held, so the drawdowns were low. It was really still, we're dealing with an ideal world, and it happens to be that CTAs made money, but the market regime has not shifted.
It sounds like as a guy who does believe in trend following, the point that you're really making is that too many trend following traders, unbeknownst to perhaps, I'm sure their investors know what they're doing, but unbeknownst to typical marketing, you see too many trend following traders have moved away from their core competency and are essentially going with the crowd that does all the things that trend following is supposed to be the hedge against. What you really want to see is the equity downturn, and that's where you believe that the true trend following traders who give that great benefit will appear.
Yeah, I want everybody to make money, but I can see sometimes, maybe this might sound arrogant, but I can see people going in the wrong direction based on short-term positive reinforcement in certain markets. So equities and fixed income are obvious that they're not naturally priced. And yes, I do want trend followers to make money. It would be most obvious when let's say the lack of discipline, or the lack of integrity of CTAs will be most obvious when equity markets go down and fixed income goes down at the same time. Then you're going to see who's really a CTA and who pretended to have these very long-term models which are really irrelevant because they're too far away from the market. So the most positive convexity comes when you're trading between 7 to 10 days per trade on average. the industry today is at 30 days plus on average. It's way too long term to participate in a volatile market or to participate in dramatic trend reversals. So now this has not, nobody has paid the price for this lack of discipline, but I would say that investors, if they could learn this lesson before they actually pay the price for it, it would be great. Same thing for CTAs. I want everybody to make money. I mean, I think there's no reason to be happy at other people's, things. But I think that discipline in the long term, even if it means you have to lower your expectations for the present moment, discipline and delaying gratification is, in the long term, the best way to go.
I'm going to be interested to see if I receive the hate mail now, because you've laid the controversial case out that 7 to 10 days is more in the optimal range, and the over 30 could be an issue when the tide goes out, so to speak.
Let's say today the 300-day moving average is about 5% lower. For a 3-day moving average to go down there. I mean, the market is going to be down like 10% at least, where CTAs, I would say, as an index, would still be long the stock market. Yes, there's a dangerous setup going on here.
Nigol, where can we send people and they can there's access to all your papers? Actually, I couldn't find your papers at your website, but I did a search for your name and Quest Partners, and I went to Google in the PDF search, and I quickly found them. So I don't know if regulation keeps them off your website, or you can easily find them at other places in the internet, or I'm not supposed to say that. I'm not sure.
They are in our website. You need to actually register with us, and we give you access to them. But by now, they've been posted all over the internet. So all 6 of them are actually everywhere available on trading sites, et cetera, et cetera.
Okay. Hey, where can we best send people, Nigol? Where's the best website to send people to?
So questpartnersllc.com is our website.
Well, listen, hopefully we will have, I think it's going to be really fun to talk to you once the proverbial, and I can always bleep this, the proverbial shit storm hits. It's going to be fun to talk to you when it hits. Because you're making the case it's going to hit. You just don't know when. I hope we're both still alive when it hits, because so far those central banks have done a heck of a job of engineering things, haven't they? You got to give them credit.
Yeah, they're doing the right thing based on the resources they have. They're doing the right thing based on the resources they have. That's every word here counts. It means they don't have much more that they can do based on the political picture taken into account. You have to read very deeply into each one of these words, and you'll see that they have no option but to do what they're doing, unfortunately. Yeah.
And I hope people truly understand the wisdom as you say that. They have no option to do except what they are doing. If
you take the political picture in mind as well, into account. Yeah.
Sir, thank you. We will talk again.
Thank you, Michael. Thanks for the great questions. And
it's always fun.
Thanks for all the interviews. They're very informative, and I've been listening to other traders as well, and really enjoying your perspective on the market.
Yeah, feel free to toss me leads too. If you've got some associates, peers, otherwise people you think I should chat with, I will always take the leads and introductions. I'm equal comer. Bring them on.
I'll think of some names, actually. I'll send you to some names. There's some interesting stuff out there.
Okay, great. Thank you, sir. We'll talk again. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.